Hello, I'm Michael Smith. Welcome to this next edition of the Lowdown. Here joining me is Kevin Lenox. Kevin, how are you doing?
I've had better days.
Had better days, better weeks. Well, today we're going to have a good discussion, lots to talk about, but I thought we'd kick things off. The Federal Reserve, FOMC, basically came out this week and announced the biggest rate hike increase that we've seen since, in the last quarter century, 75 basis points. Just kind of get your thoughts around that, and let's kind of talk about policy and where we think the Fed is going.
The Fed is fighting for credibility here, and they were in the quiet period over the last 2 weeks where no Fed governors were allowed to speak publicly. And as they've done before, they used a mouthpiece at the Wall Street Journal to say, we need to do 75 basis points.
Yeah.
And everybody across Wall Street shifted to 75 basis points. But, you know, I did not think the presser yesterday went well for Powell either. I mean, I'll quote exactly what he said here. No sign of a broader slowdown in the economy. The Atlanta Fed just came out revising GDP to 0.
Yes. And then negative 1.5 in the previous quarter.
So we could have a technical recession.
We could have a technical recession, absolutely.
And he did not seem comfortable. And I don't think he did anything really to establish credibility. They are far behind the curve. And, you know, really the only thing worse than making a policy mistake last year is making one this year in the opposite direction.
Absolutely. Well, think about that for a minute. It's been over, a year since transitory, which, basically the Federal Reserve came out and said they think that inflation is going to be transitory, which means it's going to pass. We all know that's not true, right? They came out at the beginning of the year and they basically said, we are going to pick one thing and we're going to fight inflation. So they've kind of pigeonholed themselves into now fighting inflation. We got CPI print at its worst levels a few weeks ago, and basically now they have no choice but to continue to raise rates. 75 basis points, and I think you said yesterday, the presser, Jerome Powell left the door open for the debate of another 75 basis points or 50 basis points at the next meeting.
Right. And we're sitting there at potentially 0 GDP. It takes 3, 4, 5 months for a change in interest rates, either up or down.
Correct.
To fully filter through the economy.
Very lagging.
They have never brought inflation down by more than 2% without triggering a recession.
Well, I wanted to ask you about this because, if you've listened to Jerome Powell, and one of the things I think the media is pacifying us. I mean, Janet Yellen tells us, don't worry about a recession. President Biden tells us, don't worry about a recession. They're all trying to calm us down, trying to pacify us. But Jerome Powell has mentioned 1994, and he keeps talking about Greenspan, right? So let's just talk about 1994. We went into the recession in 1995. We had what's called a soft landing. So he keeps referring to this, and I think he wants all of us to believe we're going to have a soft landing. But let me just kind of tell you what the landscape looked like. First of all, the yield curve was far more steeper than it is currently. And we were at the early stages of a business cycle. So the Fed was tightening at the early stages. What's different this time, and you can add to this, we're at the late stage of a business cycle. We don't have that much wiggle room. So it is not the same. And so I think that's one of the things I wanted to get out there, because I keep hearing these references to 1994, 95, and this soft landing. I just don't see how they're going to have a soft landing at all. What are your thoughts on that?
They have to portray a positive outlook. Their job.
Yeah, exactly. Yeah.
And I will tell you what concerned me and a few of my portfolio manager friends, we talked last night, was that he's trying to talk with a straight face and use unemployment numbers going forward that I think are aspirational. Let's just say it that way. So unemployment, they quoted yesterday, 3.7% for this year. 3.9% next year and 4.1% in 2024. At the same time, they're bringing inflation down from 5.2% to 2.2%.
Wow. Well,
that just doesn't jive. And
correct.
Use better numbers than that, especially when you've been getting the policy calls wrong. And they keep saying they're data dependent. You can't be data dependent and provide forward guidance.
Well, also, absolutely.
And then inflation goes up, and they go, well, transitory. Inflation's really going up. Well, we're thinking about it. And they use government data that is at best coincident to the economy, and many are lagging. Many of the leading indicators that myself and others in the business really focus on have been slowing for months. And we've seen that reflected in asset classes. And when there's a disconnect between what's clearly going on in the economy and portfolio positioning versus Fed and statements from Washington, when there's a conflict, people get nervous. It causes volatility to go up. And that's just not a healthy diagram. Janet Yellen did come clean and said she was wrong about inflation.
Oh, really?
She came clean a number of years ago saying, wow, she didn't see the housing crisis develop when she was governor of San Francisco.
When have they ever been good forecasters?
They had negative amortization loans in California in 2007, 2008. She was the Fed governor at that time.
So credibility probably not that great then. Well, what do you make of Jerome Powell's comments? I mean, they're looking at headline CPI, right? That's the data they're going to follow. We know a lot of the underlying of that is very lagging. I mean, if home equivalent rents, all those things, a lot of stuff's already pretty much starting to soften or come down. But what do you make of that versus maybe the core and some of the other things they should be looking at?
Yeah, he said we're quote unquote we're reacting to the data.
Yeah,
doesn't inspire confidence.
No, not at all.
But yeah, and you mentioned different things they look at. The JOLTS, which is comes out every 2 months. And the employment month reports come out once a month. They're revised very frequently. It's not a good real-time set of data. They should be looking more at the high-frequency data.
Well, another thing, it kind of gives a state of the consumer. University of Michigan survey basically came out. I think it's had data since 1971, the lowest level ever. Basically saying the consumer right now is starting to slow down. The consumer is starting to pause. And I believe that's just, that's in all types of purchases, large purchases, small purchases, all across the board. What do you make of that survey?
I'm hearing it more and more in just my social circles.
Yeah.
And I think I shared with my family, we have 3 birthdays in June. And we go to, and it's the same weekend every month, we go to Fleming's as a family.
Okay.
And set a reservation. And so it's not a seasonal thing. I know people travel during the summer. The restaurant was less than half full.
Wow.
They're in the Woodlands, which is in Exxon's backyard, which oil stocks have done well this year. But I'm increasingly hearing about high food prices, high energy prices, electricity. And at one party I was at, somebody who's been he has some family in Europe, and he's been very pro-Ukraine. And we talked about, he mentioned that the refinery, or not the refinery, I'm sorry, the LNG plant in Freeport.
Yes.
Explosion. He said, oh, great, I guess natural gas prices are going even higher now. I said, no, actually they went down quite a bit. What? Well, yeah, we were exporting everything we could to Europe.
Yeah.
And now we have more supply at home, so prices came down quite a bit. He goes, wait a minute. I've been paying higher energy prices, higher electricity. Yeah, suddenly he's not quite so pro-war anymore. But that has really made the Fed's job
very difficult.
Yeah. They were behind the curve to begin with, but I honestly, my own view, the whole thought on the impact on food and energy prices and distribution was not worked out in advance.
No, I mean,
of this conflict.
I mean, policy has been a one step. Okay, let's do one thing. They don't think 3 or 4 steps ahead what could happen, the unintended consequences. We know that. But I think the Federal Reserve right now, and tell me if you think different or if you agree, I think right now what their goal is they're going to raise until something breaks. And they're going to keep trying to push us as far as they can. And then when something rolls over, I think they'll be very quick to come in, and be accommodative. But right now, there's how far can we take this? And at the end of the day, they're trying to break inflation. What are your thoughts on that?
I agree 100%.
Okay.
I think they will raise until they break something. And that delayed impact between raising rates and the actual impact on the economy, I think it's going to hit first. And then they will pivot, as they did in 2018.
Sure.
The reduction of the balance sheet ongoing. People make a big deal about that. The work I've done in that area suggests it won't be an issue so much for the rest of the year because tax receipts far surpassed expectations.
Okay.
So that helps, but that will really start in Q1, Q2 of next year. But
Well, so let's bring this kind of back to as an investor, right? We're hearing this, the Fed's going to, raise till something breaks. We've already seen the markets. I mean, the markets have been, pretty nasty, sell-offs that we've seen. But as for an investor, and look, we've been warning on this show for quite some time, do not exceed your bounds of risk, right? We've gone back to financial planning, update your financial plan, make sure your guardrails are on. And so we've been warning this for quite some time. But I think, one of the other things I'll continue to try to tell investors is, don't go outside your allocation. I think right now, making drastic decisions or emotional decisions are very, very likely considering all the data, but it could be very dangerous. Understand the long-term part of your portfolio. The stocks, yes, they're down, but remember, those are things for the long-term part of your portfolio. Understanding and having cash and your cash flow needs ahead of time, that you should already have, but don't do anything drastic. I think a lot of people thinking, well, I'm just going to go sell everything, go to cash. I'll wait this out, and you're going to get some green light to come back in. That's not going to happen. I think this thing is going to move very fast like it is now. Things could get uglier, but it could pivot and change very fast to the other side, making it almost impossible for anyone to time and catch. What are your thoughts on that for investors?
Mike, you make a good point, and I was in the business back before people really did financial planning, and it got very emotional then. Plus, I was new in the business.
Yeah.
But now every client has a financial plan, and we set the risk parameters around their financial plan and just their personal preferences for risk and cash flow needs and so forth. So what I've noticed as I look back compared to now is how much less emotional the conversations are, because the people come at this first, does this move in the market impact my life? Do I have a responsible advisor with fiduciary responsibility that is really looking at all of this from a planning perspective as well as a portfolio? And these conversations this year have been really very calm. And we talk a lot about the business cycle, and we've mentioned on this show, and what things you should do tactically as you move from one stage of the business cycle to the other. And something we've talked about for a long time on the radio and the last few months.
Sure.
And actually, I had a friend that said, Kevin, you're actually a little heavy on that. I think it was in the April show about now's the time to seriously take a look at your portfolio, and if you don't have some help with it, get a third party to take a look, because there have been massive differentials in returns based on business cycle dynamics. For example, we've been advocating the value side of the equation, consumer staples, and energy, that in the late stage of the cycle are the better places to be. The worst place to be is in the longer duration assets, as we call them, for example, tech stocks.
Yeah.
And as great as those companies are and cash flow machines, the valuations change when the discount rate goes up. It's a different conversation about valuations and models. But that's why we've seen such a disconnect in performance. I think value stocks are down about 8% on the year. NASDAQ, I think, is down about 28%.
Yeah.
And then in the late stage of the cycle, you would shift more to shorter term bonds as opposed to intermediate and longer term bonds. And the difference between short and intermediate is about 6%.
Well, I'll add to your comments about the plan, and again, I always say this, having a financial plan through these times, especially the hard times, the pivotal points that we're going through, that is a calming effect to have a plan, to know and understand your risk. Trying to do this without a financial plan, in my opinion, is disastrous. You will not have anything that can verify you're taking too much risk, too little risk, or anything that's just verifying the data. You're basically out there operating in the wind, and that's not going to be a good thing. So I would say if you don't have a plan, you've definitely got to get one. And so, like I said, this is going to be a very difficult market to navigate for quite some time. We got a lot to get through. And one thing I want to ask you about is the U.S. dollar, right? So the role of the U.S. dollar, we've been talking about the dollar and its role for a long time. It's been appreciating, and as it appreciates, other economies, again, most of 80% of the trade's done in dollars. So it affects the emerging economies. You've seen that effect. But also with us tightening, we're heading into some sort of potential liquidity crisis. It reminds me of the Thai crisis back in, 97, where the dollar was rising and you started causing potentially a liquidity crisis, not in the United States, but elsewhere. What are your thoughts on that and the dollar itself?
Exactly. It's a revisit. I think it was 97, 98 in that period. And there are several $1 trillion in foreign debt that is denominated in U.S. dollars. both government and corporate. And the reason they do that is it's easier to float a large bond issue at a lower interest rate. The problem is if the US dollar appreciates relative to that currency, then it takes that much more, for example, pesos.
Yes.
To pay. That takes away from growth. So that is why a strong dollar is a potential wrecking ball to global growth. It is a distinct headwind, and when the Fed is raising interest rates by 75 basis points, it just puts more pressure on those leveraged foreign countries and economies.
So Kevin, last question. What about this deglobalization, this onshoring that we've been hearing about, that on top of already, the inflation and high prices? How does this pan out? How do you think this affects prices in the long term? In short,
it winds up with a higher level of inflation going forward, because this whole bull market over the last, since 1980, has really been predicated on globalization, outsourcing of manufacturing, which kept prices in check. If we start onshoring manufacturing or nearshoring to other more friendly countries, there's going to be a higher manufacturing cost that will then filter through the rest of the economy. So on that basis, it'll be much more difficult to get back to that 2% goal that the Fed has in place. So longer term, we're likely to settle, at least for the next 3-4 years, at more 3.5%, maybe 4% inflation versus going straight back down to 2%, as is the Fed's goal.
Well, and one of the things, and I think that's misconceived, is that as prices or costs may come lower for some manufacturers, they're not going to pass that back on. They're not going to go, wait a minute, we've increased the price of X, we're going to lower it back down. What ultimately happens, that price increase won't happen for multiple years, and we'll look back and it'll average somewhere around 3% or whatever that may be. But they're not going to lower the prices. What we have now, we're going to be here, and maybe we just don't see those increases, further ahead.
Well, that'll pinch corporate profits.
Absolutely, yes. So growth is going to be very difficult longer term, despite what you see now. But growth in the economy is going to be back to the very low levels or slow levels that we've seen prior to the pandemic.
That's why it's very important to try to isolate those companies that can pass along price increases and those that can't.
So Kevin, last thought here. You're Jerome Powell. You're sitting, seeing everything that's happened. What is your next move?
Retire.
I love it. Yeah.
He's thinking, why the heck did he come up to be reappointed?
Not a bad time to. Well, do you think he continues the debate, moving with rates until something breaks?
They don't want to do that, clearly, but I think they have to stay on a tighter path. But I think at the end of the day, they will pivot when financial conditions tighten. This is not going to be a Volcker type from the late 70s, early 80s, where you raise interest rates until you actually break the economy. I think he will stop short of that, but something will break in advance. So just kind of quickly here, financial conditions haven't tightened in the credit markets as much as stocks would imply, because corporations raised so much cash at next to nothing post-COVID. So that wall of maturity of corporate debt has been pushed out. So that gives companies some breathing room. And I've said for a long term that the Fed is reacting much more to financial conditions than they do to stock prices. They tend to move pretty close together. But when the credit market seize up, that's when they raise the surrender flag. So I see a couple more tightenings, but they will look for a pivot when financial conditions tighten. And at the end of the day, there's two mandates: full employment and stable prices. At the end of the day, he's going to support the economy and employment and take his chances longer term with inflation. And we have demographics, aging population, improving technology as big disinflationary factors. And if something gets resolved, I don't know what the off-ramp is at this point with Russia and Ukraine. But outside of that, I can see a slower path down. But I think they just have to get some credibility here by pushing rates to at least a closer level to inflation.
So expect market volatility. Looking at the data, they're going to become data dependent. They're going to need to see several months of improving data. We're not seeing that yet. So this thing is likely to be a volatile market for quite some time. Maybe towards the end of the year, we start to see some softening data and maybe a pivot at that point. But right now, it's going to be volatile. Be prepared. Update your financial plan. And thank you for joining us, Kevin. It's been great as always. I'm Michael Smith, and thank you for listening to The Lowdown.